Happy greetings everyone. I am Wilmer Baracol. We are the Group 6 and we will discuss Chapter 10, Compensation Income. Chapter 10 discusses employer-employee relationship. We already know what is employer and employee. Elements of employer-employee relationship under case law. First is selections of engagement of employees, payment of wages, power of dismissal, and power of control. These are the process and the powers of employer. Types of employees as to function. First is managerial employees. They are the one who manages the organization itself on the internal. Next is supervisory employees. Supervise managerial actions. The third is rank and file employees. Holds managerial and supervisory functions. Types of employees as to taxability. First is minimum wage earner. The second is regular employees. The tax model compensation income. Gross compensation income less than non-taxable compensation. The difference is the taxable compensation income. Non-taxable compensation. A. Mandatory deductions. These are the mandatory deductions are GSIS, SSS, Spell Health, and etc. B is exempt benefits. Exempt benefits under NIRC as amended and special laws. First is remunerations received as incidents of employment. These are the retirement benefits, termination benefits, pensions, benefits from SSS, benefits from GSIS, or the COVID-19 benefits to health workers. The second exempt benefits is the de minimis benefits. The third month pay is the third. And the fourth is benefits minimum wage earners. De minimis benefits are the benefits exempt and cap to tax when. First is monetized value leave not exceed 10 days per year. Medical cost allowance not exceed 1,500 per employer per semester or 250 per month. Rice subsidy not exceed 2,000 or 50 kilogram per month. The fourth is uniform and clothing allowance not exceed 6,000 per annum. Fifth is actual medical assistant not exceed 10,000 per annum. Sixth is laundry allowance not exceed 300 per month. Employee achievement award, tangible property with an annual monetary value not exceed to 10,000. Gifts given during Christmas and anniversary celebration not exceed to 5,000 per employee per annum. And is the daily meal allowance for overtime work and night or graveyard shift not exceed to 25% of minimum wage per region basis. Tenth is benefits received by an employee by virtue of collective bargaining agreement or CBA and productivity incentive scheme do not exceed 10,000 per employee per taxable year. 11th is monetized annual sick leave, which is paid to government officials and employees. These are the taxable de minimis benefits. First is access to the de minimis over the regulatory limits. The second is other benefits relatively small value that are not included in the list of de minimis benefits. We have here the illustration to determine the excess of de minimis benefits, which are the taxable. Illustration 1. De minimis limits. Alexandria, a private employee who is paid a 600 daily rate, receives the following benefits during the year 2021. Monetized annual vacation leave credits 9 days. Monetized annual sick leave credits 9 days. Rice subsidy 2,500 per month is equal to 30,000. Clothing allowance 9,000. Laundry allowance 6,000. And the required is determine the taxable amount of de minimis benefits. This is the solution. The monetized annual vacation leave is the total of 5,400 and this is the actual value. And the regulatory limit is 6,000. So there is no excess. Second is monetized annual sick leave. Actual is 5,400. Since Alexandria is a private employee, there is no limit. So there is excess of 5,400. Medical assistance 7,000. The regulatory limit is 10,000. So there is no excess. Rice subsidy. The actual is 30,000. The limit is only 24,000. So there is an excess of 6,000. Clothing allowance. The actual value is 9,000. The regulatory limit is 6,000 only. So there is the excess of 3,000. Laundry allowance. The actual value is 6,000. The regulatory limit 3,600. So there is an excess of 2,400. The total excess is the 16,800. This is the taxable de minimis as other benefits. We have here the illustration 2. Hislin, a government rank and file employee, received the following benefits. Monetized annual vacation leave credits 10 days. Total of 6,000. Monetized annual sick leave credits 15 days. Total of 9,000. Uniform allowance 5,000. Laundry allowance 4,800. We are going to determine the amount to be included in other benefits, which is taxable. This is the solution. Monetized unused vacation leave actually is 6,000 and this is exempt because it is 10 days and the regulatory limit is 10 days and there is no excess. Monetized unused sick leave. The actual value is 9,000 and regulatory limit, since this is a government employee, so the government will pay and there is no excess. Uniform allowance. The actual value is 5,000. The regulatory limit is 6,000, so there is no excess. Laundry allowance. The actual value is 4,800 and regulatory limit is 3,600. Then there is the excess of 1,200 and the total is 1,200 only, the taxable de minimis as other benefits.
Hello everyone, I'm Rhea, Lynnette, Enero, and I would like to impart to you all my short discussion regarding on my assigned topic in relation of the compensation income chapter 10. So we have here the commutation of accumulated leave credits. It is also called as terminal leave pay. This is due to involuntary separation from employment of the employee. Treated as de minimis benefits subject to 10-day leave credit limit. So these de minimis benefits are benefits of relatively small values provided by the employer to their employee, and it is no longer exempt as part of exempt benefits. For the 13th month pay and other benefits not in excess of 90,000, The value of the 13th month pay benefit combined with any other allowances or benefits that the employee receives from their employer during a calendar year does not exceed 90,000, then the total value of those benefits or allowances will be exempt from income tax. Benefits exempt under treaty or international agreement. Foreign governments or international organizations with their non-Filipino staffs are exempt to income tax. As what we have tackled in Chapter 1, this is because of the international committee agreed by all countries wherein nations must observe mutual courtesy and reciprocity. Hence, governments do not tax the income and properties of other governments. Exemption from withholding tax does not mean income tax exemption. Only non-Filipino nationals are exempt. However, Filipino employees of foreign governments and international organizations are taxable as rule, except only to employees of the following organizations. We have here the United Nations, specialized agencies of the United Nations, Australian Agency for International Development, Food and Agriculture Organization, World Health Organization, United Nations Development Program, International Organization for Migration, and International Seabed Authority. For confirmation of tax exemptions, Filipino employees under the terms of international agreement shall file an application for confirmation of tax exemption with the BIR's International Tax Affair Division. Hence, the employee is taxable without the confirmation certificate. Employees of Philippine embassies or consulate offices. Employees working in Philippine embassies or Philippine consulate offices are not considered non-resident citizens and are therefore subject to Philippine income tax. We have the summary of rules. So as what you can see here in the table, in the Philippines, Filipino citizens are taxable in foreign embassy, missions, or organizations. On the other hand, aliens are exempt. But in Philippine embassy or consulate offices, both Filipino citizens and aliens are not applicable. In abroad, Filipino citizens and aliens are both exempt in foreign embassy, mission, or organizations. On the other hand, Filipino citizens are taxable in Philippine embassy or consulate offices, and aliens are exempt. Benefits required by the nature of or necessary to the trade, business, or conduct of profession of the employer. Necessity of the employer rule are benefits and allowances that employees to effectively and appropriately execute their duties required by their employment. These are not employee benefits, thus, these are not considered as compensation income and are therefore exempt from income taxes. Benefits for the convenience or advantage of the employer. The convenience of the employer rule regulates the income tax of employees working for employers outside their states. It is likewise exempt from income tax. Moreover, these benefits are not considered as employees' reward since they are not intended for free personal consumption or disposal of the employees, but as implements of the employer's business to ensure its convenience. However, if the expense is unreasonably excessive, making it depart from the nature of a reasonable business expenses, such as when it deliberately granted to include a benefit for the employee, the portion of the expense representing provision is considered a taxable fringe benefit. These are regarded as hybrid expenses because they are partially business expense and partially employee benefits. For composition of taxable compensation income, we have the regular compensation and the supplemental compensation. But before we are going to tackle these two, let us first acknowledge the adjunct category to the supplemental compensation. The 13th month pay and other benefit is necessary to contain incentive pays and all other taxable employee benefits not classifiable as regular or supplemental compensation. Benefits not exceeding 90,000 is an exclusion from gross income, and the excess above 90,000 is added to supplemental compensation. We have here an illustration. An employee received 40,000 regular compensation, 120,000 supplemental compensation, and 100,000 for the 13th month pay and other benefits. The taxable compensation income shall be computed as follows. Regular compensation 400,000, supplemental compensation 120,000 plus 100,000 minus 90,000, we have 130,000. Therefore, the taxable compensation income is 530,000 pesos. Regular compensation income. This includes fixed remunerations due to be received by an employee every period, such as basic salary. So, basic salary, of course, is the amount of money a salaried employee earns before their employer makes any deductions or additions. Fixed allowances are fixed amounts and regularly received as part of the basic monthly, bi-weekly, weekly, daily salaries or wages. Exemption rule on the taxability of allowances. A. Ordinary and necessary allowances for traveling, representation, or entertainment expense of employees incurred in the pursuit of the employer's trade, business, or profession. B. The expense is subject to accounting or liquidation. C. Any excess advances are returned to the employer. So hence, variable and liquidated allowances are not subject to tax. However, allowances that are retained by the employee himself shall be considered compensation. Paid vacation and sick leave allowances. The paid absences of an employee applied against his vacation or sick leave credits, which are normally received as part of their regular salary, is part of their regular compensation. Non-compensation items includes fees, commission to non-employees, tips, and gratuities. Valuation of compensation paid in kind. It is taxable at the fair value of the consideration received. If received in shares, the fair value of the shares at the date service were provided is used. We have here an illustration. The following pertains to an employee in 2021. Gross salaries 400,000, cost of living allowance 36,000, fixed monthly transportation allowance 2,000 times 12 24,000, deduction for withholding tax and compensation 10,000, and deduction for employee share in SSS, PHIC, and HDMF worth 32,000 pesos. The taxable compensation income shall be computed as follows. Gross salaries 400,000, cost of living allowance 36,000, fixed monthly transportation allowance 2,000 times 12 24,000. Therefore, we have a regular compensation income worth 460,000 less non-taxable compensation mandatory deduction worth 32,000. Therefore, we have the taxable compensation income worth 428,000 pesos. For illustration 2, an employee who was terminated in 2021 due to business closure of the employer received the following: unpaid 2021 salaries 400,000, unpaid 2020 salaries 36,000, reimbursement for transportation expenses 24,000, and termination pay worth 100,000 pesos. The taxable compensation income shall be computed as follows. Gross compensation income 200,000 plus 20,000 plus 100,000 is equal to 320,000 less non-taxable compensation non-taxable income worth 100,000. Therefore, we have a taxable compensation income of 220,000 pesos. Supplementary compensation. Supplementary or additional compensation includes performance-based remunerations to an employee in addition to the regular compensation with or without regard to the payroll period. Additional compensation under current tax rules. We have overtime pay, hazard pay, night shift differential pay, holiday pay, commissions, fees including director's fees if director is an employee, emoluments and honoraria, taxable retirement and separation pay, value of living quarters or meals, gains and exercise of stocks option, and profit sharing and taxable bonuses. So, for stock option plans, these are a way of motivating employees, allowing them to earn additional rewards on the appreciation of the stock price of the company. We have the types of option. The equity settled options. This entitles employee to purchase shares of stocks of the employer at a predetermined exercise price on the grant date. Cash settled options. This option entitles the employee to receive in cash the excess of the fair value of stocks over the exercise price without actually delivering stocks. Upon the exercise of the option, the excess of the book value or fair value of the stocks, whichever is higher, less the exercise price set at grant date, is treated as follows. A. Additional compensation income if the employee is a rank and file. B. Fringe benefits if the employee is managerial or a supervisory employee. This rule is applied regardless of the type of the option. Illustration of equity settled option. Mr. Anthony, a rank and file employee, received a stock option from his employer, ABC Inc., entitling him to buy 10,000 of ABC's share at a strike price of 100. In April 2021, Mr. Anthony exercised the option when ABC share was selling 150 per share. The shares had a book value of 145 per share in the latest published financial statements of ABC Inc. After 2 years, he sold the shares for 180 per share. Fair value of stocks 150 times 110,000 shares, we have 1,500,000 less exercise price option 100 times 10,000 shares, 1 million. Therefore, we have a compensation income discount of 500,000 pesos. Treatment of the subsequent sale of the shares. If the employer corporation is a 1. Domestic corporation and the sale of the stocks is made A. Through the PSE, the sale is subject to the stock transaction tax of 60% of 1% of the gross selling price. The tax will be computed as selling price 180 times 10,000 shares, 1,800,000 multiplied by stock transaction rate 60% times 1%. Therefore, we have a stock transaction tax of 10,800 pesos. B. Directly to buyer, the net gain on sales is subject to the 15% capital gains tax. The tax shall be computed as follows. Selling price 180 times 10,000 shares, 1,800,000 less tax basis of shares sold, 1,500,000. The capital gains is 300,000 multiplied by the CGT tax rate 15%. Therefore, we have a capital gains tax of 45,000 pesos. 2. Foreign corporations. The net gain on the sale is a capital gain subject to the rules of irregular income tax. The gain subject to regular tax shall be computed as follows. Selling price 180 times 10,000 shares, 1,800,000 less tax basis of shares sold, 1,500,000. The capital gains is 300,000 multiplied by holding period rate 50%. Therefore, we have a capital gains tax of 150,000 pesos. The rules and dealings in other capital assets will be discussed in Chapter 12. That would be all. Thank you.
As now, for cash settled option under the stock option plans, we are going to get the fair value at where at close. 150 times 10,000 shares is equals to 1.5 billion less the exercise price option of 100 times 10,000 shares is equals to 1 million. And our difference is the cash fringe benefit subject to final tax, which is 500,000. Then, what if option is an equity settled option? So Mr. Anthony shall receive the following number of ABC share pursuant to the terms of option plans. So we are going to get the fair value of stocks, 150 pesos times 10,000 shares is equals to 1.5 million, less exercise price of 100 times 10,000 shares is equals to 1 million, and their difference is the increased value of stocks covered by the option. And it will be divided by the exercise day closing price at 150 pesos, and the answer is 3,333.33 number of shares. So, under the regulation of the fair value of listed stocks in the simple average of high and low, computed as 156 plus 146 divided by 2 is equals to 151 per share, and the fringe benefit will be valued based on the 153 pesos per share. Higher book value as follows. Number of shares, 3,333 multiplied by 153 will get the stock fringe benefit subject to final tax, which is 510,000. Profit sharing and taxable bonus. Profit sharing is an organization for controlling all the factors that influence profit, such as marketing and sales, productivity, and administrative factors. Bonus are supplemental or additional compensation. Productivity Incentive Act of 1990, RA 6971, it is linked to improve the productivity usually in terms of cost saving through waste reduction, efficient labor utilization, or increased volume of production. Under the NIRC, productivity incentive bonus is considered as part of other benefits under 13th month pay and other benefits. So 13th month pay and other benefits. 13th month pay and other benefits includes 13th month pay, other benefits such as Christmas bonus, cash gifts, additional compensation allowance or ACA, 14th month pay, 15th month pay, etc., and other fringe benefit of rank file employees. 13th month pay. The 13th month pay of government employees consists of Christmas bonus equivalent to 1 month salary plus 5,000 cash gifts. So the 13th month pay of private employees is equivalent to 1 month salary. The Christmas bonus of private employees, which is non-performance based, incentive pay is part of other benefits. In nature of profit sharing should be treated as additional compensation, not as other benefits. So, and Christmas gifts of government employees is specifically designated as part of 13th month pay and other benefits. Bonus versus gifts. Bonus is based on performance and is non-discretionary to the employers, while gifts is a gratuity and is discretionary upon the employer. Employee personal expenses, such as but not limited to rental resident, grocery association, or club membership dues, travel or vacation expense, or tuition fees when assumed or paid by the employer. Tax treatment of other fringe benefit. For rank file employees, treated as compensation income as part of other benefits, 13th month pay and other benefits. For managerial or supervisory employee, treated as fringe benefits subject to fringe benefit tax. Other fringe benefits of managerial or supervisory employees are excluded from their 13th month pay and other benefits. Illustration. The 1,000 monthly excess constitute a taxable de minimis benefit taxable as compensation as part of other benefits for rank and file employees. It is fringe benefit subject to final fringe benefit tax for managerial or supervisory employees. Tax treatment of 13th month pay and other benefit. RR 2-998 provides that 13th month pay and other benefits are exempt from withholding or compensation provided they do not exceed 90,000. It follows therefore that the excess 90,000 is subject to the withholding tax on compensation. The question is determine the taxable 13th month pay and other benefits. Also, Christmas bonus of 13th month pay of government employees is 70,000, cash gifts, which is 5,000, and additional compensation allowance, 36,000, and excess uniform and clothing allowance, 1,000, and the total 13th month pay and other benefits would be 112,000. So, less exclusion threshold, 90,000, and the answer will be the taxable 13th month pay and other benefits, which is 22,000. Another illustration. Compute the 13th month pay and other benefits. So, Christmas gift, which is under the de minimis, 30,000, and it has a limit of 5,000. So the excess would be the other benefits, which is 25,000, and uniform and clothing allowance. Uniform and clothing allowance would be 8,000, and it has a limit of 6,000. So the excess would be the other benefits of 2,000. So laundry allowance, which is 6,000, and the limit was 3,600. So the excess would be the other benefits, 2,400. Total, the other benefits is 29,400. 13th month pay, which is 72,000, and it will be the total 13th month pay and other benefits, which is 101,400. Less the exclusion threshold, which is 90,000, and we'll get the taxable 13th month pay and other benefits, which is 11,400. Integrative illustration for compensation income. We have 4 sections: the de minimis, non-taxable, other benefits, and taxable benefits. For the minimis, there is only one, the uniform allowance, which is 12,000. And in the non-taxable section, we have the mandatory deduction, which is 80,000, and we have the rata and the pera. 18,000 and 24,000, and the limit for uniform allowance 6,000. 18,000 plus 24,000 plus 6,000 is equal to 48,000, plus the exclusion threshold that up to 90,000. 48,000 plus 90,000 is equal to 138,000. And we're going to add the mandatory deduction, which is 80,000. So 80,000 plus 138,000 is equal to 218,000. And now, for the other benefits, we have the Christmas bonus and the Christmas gifts. It is 87,000 and 5,000. And also we have the excess for uniform allowance, which is 6,000. So 87,000 plus 5,000 plus 6,000 is equals to 98,000. And we are going to deduct the exclusion threshold up to 90,000. So 98,000 minus 90,000 is equals to 8,000. And now for taxable benefits, we have regular compensation, which is 964,000, and the honoraria of 15,000. So 964,000 plus the 15,000 honoraria is 979,000. And now we're going to add the 979,000 plus the taxable excess 13th month pay and allowance, which is 8,000. And we can get the 987,000. And now for presentation in the income tax return of the employee, we have the gross compensation income 1,205,000. And we're going to deduct mandatory deduction plus the exempt benefit, which is 80,000 plus 138,000 is equals to 280. So 101,205,000 minus 218,000 is equals to 987,000.
The French benefits tax on managerial or supervisory employees is subject to a grossed up final tax at the rate of 35%. So it is computed as follows. Taxable French benefits, 42,200 pesos divided by gross up by rate 65% is equal to 64,923 pesos, which is our grossed up monetary value, multiplied by tax rate, which is 35%, is equal to 22,723, our French benefits tax. So the French benefits tax is a final tax which paid by the employer to the government. It is presumed withheld out of the French benefits of the managerial or supervisory employee. The detailed rules on French benefit taxation will be discussed in the following chapter. It is merely shown here for you to obtain preliminary understanding. Taxability of minimum wage earners, or MWE. Minimum wage earners are exempt from income tax on the following. Number 1, basic minimum wage. Number 2, other benefits or HHON, which is holiday pay, hazard pay, overtime pay, and night shift differential pay. These shall be presented as exempt benefits under non-taxable compensation income, since it is exempt from income tax. The exempt benefits of MWEs shall not be subject to withholding tax. So this is our illustration. Ms. Guevara, a minimum wage earner employed by CSO company, derived the following benefits during the year. Basic minimum wage, 124,000, and 13-month pay, 11,000, overtime pay, 80,000, night shift differential pay, 30,000, hazard pay, 15,000, holiday pay, 15,000, total of 275,000, less SSS, PhilHealth, HDMF contribution, 5,000, with net total of 270,000. The taxable compensation income should be computed as follows. Gross compensation income, 275,000, less non-taxable compensation income, which is the mandatory deductions, 5,000, and exempt benefits, 270,000. A total of 275,000 non-taxable compensation income. Gross compensation income, 275,000, minus non-taxable compensation income, 275,000, is equal to 0 taxable compensation income. So to continue with, let's go to receipt of other taxable income by minimum wage earners. Minimum wage earners are still exempt from the income tax of the foregoing exempt benefits, even if they are earning other taxable items of compensation or other income from concurrent employers, trade, business, or practice of a profession. Minimum wage earners are subject to tax only to the extent of income other than the aforementioned exempt benefits, RR11 to 2018. Hence, additional compensation such as commissions, honoraria, French benefits in excess of the allowable amount of 90,000. Taxable allowances and other taxable income given by the same employers to minimum wage earner are subject to withholding tax. Despite this, it must be noted that minimum wage earner will actually pay income tax only if their total taxable income exceeds 250,000 for the year. So here is the illustration with other taxable compensation income. Mary Lafente, a minimum wage employee, was able to close a sales deal for her employer during the year. She receives the following compensation during the year. Basic minimum wage, net 80,000 mandatory deductions, 160,800 pesos, and 13-month pay, 14,000, holiday pay, 4,000, overtime pay, 70,000, night shift differential pay, 15,000, hazard pay, 10,000, profit sharing bonus, 12,000, commission income, 370,000, a total of 655,800. The taxable compensation income should be computed as follows. Gross compensation income, 663,800 pesos, less non-taxable compensation income, which is the mandatory deductions, 8,000, exempt benefits, 273,800, with a total of 281,800 non-taxable compensation income. So gross compensation income minus non-taxable compensation income is equal to 382,000 taxable compensation income. Exempt benefits consist of the following. Basic minimum wage, 160,800, 13-month pay, 14,000, holiday pay, 4,000, overtime pay, 70,000, night shift differential pay, 15,000, hazard pay, 10,000, with a total exempt benefits of 273,800. Mayor's tax due shall be computed as taxable compensation income, 382,000, less lower limit of income bracket where taxable income qualifies 250,000 and exists of 132,000, multiplied by 20% with a total of 26,400. Issue number 2, with business income. June, a minimum wage employee, do part-time job businesses after work. He received total minimum wage of 290,000 pesos, inclusive of 11,000 13-month pay, but net of 5,000 mandatory deductions. He also received a performance bonus of 20,000 and earned 300,000 from his sideline businesses. Yung taxable income shall be computed as follows. Gross compensation income, 315,000, which is a total of 290,000 plus 5,000 plus 20,000. Less non-taxable compensation income, which is mandatory deduction 5,000, exempt benefits 290,000, and a total non-taxable compensation income of 295,000. Gross compensation income minus non-taxable compensation income is equal to 20,000 taxable compensation income, plus net income from business 300,000 with a total of taxable income of 320,000. Rules of change in status as a minimum wage earner during a year. Number 1. When an employee becomes a minimum wage earner during the year, he shall be subject to income tax only on compensation earned before becoming a minimum wage earner. So here's our illustration number 1. Anthony had a basic pay of 400 pesos per day when the minimum wage was 382 pesos per day. He is also receiving overtime pay and the year-end 13-month pay. On July 1, 2021, the Regional Wages and Productivity Board increased the minimum wage by 22 pesos per day to 404 pesos per day. Anthony's employer increased his salary to the minimum 404 pesos per day. Anthony shall be taxed on his income from January 1 to June 30 because he is not yet a minimum wage earner. The employer shall regularly deduct the withholding tax on compensation starting July 1, including overtime pay and year-end 13-month pay shall be tax exempt. If the exact amount of income taxes had been withheld by the employer for the January 1 to June 30 compensation, Anthony need to file an income tax return. Otherwise, Anthony shall file an adjustment return reflecting his compensation from January 1 to June 30 and shall pay the tax still due or claim for refund in case of excess withholding. This rule may also apply in case of A. Transfer to an employer paying salary at the minimum wage, and B. Transfer of employment to a region with higher minimum wage. Number 2. When an employee ceases to be a minimum wage earner during the year due to increase in salary, only the income for the rest of the year is taxable. So here's our illustration. Andrea is a minimum wage earner. She was promoted and was given a salary raise above the minimum wage starting August 1, 2021. Andrea shall be exempt from income tax from January 1 to July 31 because she is a minimum wage earner. Effective August 1, 2021. Andrea shall be subject to tax. The employer shall start deducting the withholding tax on compensation from Andrea's salaries effective the same date. If the employer properly withheld the income tax for the period August 1 to December 31, Andrea need not to file an income tax return. Otherwise, she shall file an adjustment return reflecting her compensation for the same period and shall pay the tax due or claim for refund in case of excess withholding. This rule may apply of A. Transfer to an employer paying salary above the minimum wage, and B. Transfer of employment to a region with lower statutory minimum wage. Number 3. When an employee ceases to be a minimum wage earner during the year by disqualification, example, earning taxable income. Note that if the taxable income of the employee does not exceed 250,000 pesos for the year, there will be no income tax due for the period under the tax table.
Treatment of cost of living allowance of MWES. Under RMC 23-2011, COLA, which forms part of the new wage rates prescribed on B, the statutory minimum wage should be treated as a separate or other benefit. So under this Revenue Memorandum Circular, the cost of living allowance provided herein shall apply to all covered workers and employees in the private sector in the Region 3 regardless of position. It covers all minimum wage earners in the private sector in the NCR regardless of their position or status of cost of living allowance. Next is the withholding tax on compensation. It is a method of collecting the income tax in source upon receipt of the income. It applies to all employed individuals, whether citizen or aliens. So this one is a tax deducted by an employer from an employee's income. So since the employee's income is not fixed, the amount deducted from the employee's income is based on the amount that an employee earns over a certain period of time. And we have our example in this next page. And next is the procedural computation of the withholding tax on compensation. So first, determine the total monetary and non-monetary compensation of the employee for the payroll period, monthly, semi-monthly, weekly, or daily. Segregate non-taxable benefits, mandatory contributions, and supplemental compensation. Second one is to determine the bracket that applies to the regular compensation of the employee for the applicable payroll period. Determine the basic tax for the bracket. Third, add supplemental compensation to the excess of the regular compensation, subject the total to the incremental tax rate for the bracket. And fourth, total the basic tax and the incremental basic tax. So those are the procedures to compute for the withholding tax on compensation. So let's use those procedures in this illustration. Olongapo Company pays employee Marudu weekly. Marudu has a weekly salary of 10,000 before 500 mandatory contribution for SSS, PhilHealth, HDMF, and union dues and 1,000 non-taxable benefits. So Marudu's taxable compensation shall be computed as his gross compensation, which is 10,000 pesos, less the mandatory contribution 500, his non-taxable benefits 1,000. So 10,000 minus a total of 1,500 is equal to 8,500, which is his taxable income. So Marudu's 8,500 weekly taxable income qualifies under column 3 under the weekly payroll period. ABC Company shall compute the withholding tax on compensation as follows. His regular compensation income, which is 8,500, less the base amount at column 3 weekly, which is 7,692, is equal to 808, multiplied by the incremental tax rate, which is 25%. His total withholding tax and compensation is 778.92. And next, the amount of compensation income that will be released to Marudu shall be gross compensation 10,000 minus mandatory contribution 500 minus non-taxable benefits 1,000 is equal to 8,500 minus withholding tax and compensation 778.92 is equal to 7,721.06, which is the net payroll due to Marudu. And next, the year-end tax adjustment. It is the process of determining the annual income tax due of each employee for all the salary and other supplementary income received, including those from previous employer, and comparing it with the total monthly taxes to arrive at the adjusted withholding tax due. So, these are the other supplementary income examples: the overtime, bonuses, commissions, and other benefits. And next is the benefits not subject to withholding tax on compensation under RR 298 as amended. So in here, you can just pause the video for you to be able to read and also take notes. Next is the deadline of filing and remittance of the withholding tax on compensation. So it is filed by a withholding agent who deducts and withholds taxes and compensation paid to employees. So this form shall be filed and the tax should be remitted on or before the 10th day of the month following the month in which withholding was made, except for taxes. Penalties for non-compliance. Employers are subject to the same penalties discussed in Chapter 4 for more compliance of withholding tax requirements. So failure to do so will result into violations and penalties such as being filed with 35% surcharge on the amount due, 15% annual interest plus compromise penalties required by the tax code. Treatment of the withholding tax and compensation. This one needs to file a consolidated income tax return, which is a corporate income tax return of an affiliated group of corporation who elect to report their combined tax liability on a single return. The purpose of the tax return allows for corporations that run their business through legal affiliates to be viewed as one single entity. Substitute filing of tax return. Under the substitute filing system, the employer files the income tax return of the employee. If the amount of the tax is correctly withheld by the employee is no longer needs to file an annual tax return. So an individual taxpayer will no longer have to personally file his own income tax return, but instead the employee's annual information return on income taxes withheld file will be considered as the substitute of the employee.